So I think we're just going to get started. And for some of you that you haven't met us before, my name is Lucia Xiao, and I'm a property investment mentor, financial advisor, and a founder of Finax Mortgages Insurance. And also an author of the book Financial Freedom 5 Steps 5 Years. So basically just my personal story of from living in a like a one-bedroom place to later on being able to build a like I think it was 5 years. It took me 5 years to actually build a $17 million property portfolio, and now it's probably sitting at like close to $30 million. So it's achievable because obviously we do have clients. They also like been with us 2-3 years, and then they actually had increasing their portfolio to from 500K to nearly like 10 mil. So absolutely, if you are interested in how to actually being able to buy or investing in Auckland, especially the first home, and absolutely get in touch with us. So joining us today is actually one of our advisor, Lillian. Lillian's background is actually coming from the ASB business banking. So you will know that she's obviously very good with the mom and dad clients. And also, if it's you running your business, you are self-employed, you're running your business, or like if you are interested into become a property investors, construction loans or business loans, and Lillian's really, really familiar with all those types of the applications, how to present them well, and and tonight I think she's going to share with us, is it your $5 coffee? It's going to stop your application. So basically talking about this new Cccfa, which is what's the whole title there? Consumer contract. Am I right?
Credit Consumer Contract. Consumer Act.
So basically, Lillian's going to cover like what's the Cccfa, and also how can you actually overcome that, to actually make sure that you do have a strong application. The bankers are actually happy to actually lend you the money to buy your own home or buy your investment property. Someone was talking about the want to get a mortgage with NZ. No problem, because I don't know how many lenders we have. I think we have access to all the main banks and also the local small banks. SBS, Corporate Bank. All those small banks. Also, we have access to the Chinese banks. So for some of you, you don't know. They are Bank of China. They are ICBC. Korean Bank. The Chinese construction bank. So we do have a number of assets, and as well as the private lenders. So like second tier lenders. So our job is basically to get the money for you in order for you to actually buy your home, buy the investment property, in order for you to actually get on the ladder or continue to actually achieve your financial freedom here. Okay, so I'm going to get Lillian to take over from here.
So hi everyone, thank you so much for tuning in tonight. And yes, like Lucia said, the main focus point for tonight is that we will be talking about, I guess, the popular topic in the financial world out there at the moment is about the Cccfa, in terms of how it's impacting your application, what the bank is looking at, and why is it seem to be harder to actually get your loan approved. So I guess I'll just kick straight into it. At the end of the sessions, obviously we will have a Q&A session, so feel free to just pop your questions in there, and then I will answer them at the end of the session. So I guess first of all, I'll go over in regards to what does Cccfa stand for. So it is a Credit Contracts and Consumer Finance Act. What it is there to ensure that you are able to make informed choices, knowing what you are agreeing into, and to keep track of your debts. So the main purpose of the Act is being issued out is to protect you as the consumer, or protect you as the borrower. So what does the Act requires is it requires the lender to act responsibly at all times. What it means is that it is to help to protect with you when you are borrowing money. It set out rules that your lender must follow when lending you money. It also basically the rules meaning that you'll get useful information to help you to shop around for the best credit and understand what you are agreeing into. It comes out in terms of the lending contract should mention in regards to the amount that you borrow, the interest rate that you're needing to pay, your repayment cycle, any fees, anything that's involved, your loan terms, and it all comes out to all of that kind of information. So you're able to make an informative decisions when you're getting into or signing yourself into the contract. When I enter into a Cccfa. So when a consumer borrows money or buy goods on credit, so for example, if you're buying something on hire purchases or on credit cards, you have the rights under the Credit Contract and Consumer Finance Act, and that is where you have the right to understand all of those details of the lending in terms of interest rate, the repayment, and etc. So the Cccfa only applies to when the borrower is a private individual. So it's not when they are a company or an incorporated society. The credit is to be used predominantly for personal, domestic, or household purposes. So not for business or investment purposes. So for example, if you're getting a home loan or a personal loan, your personal credit cards, that all falls under the Cccfa. However, if you are getting a business loan, let's just say to start up a new business or to purchase assets or business assets, the Cccfa doesn't apply because it's not for private individuals, which is you as a consumer. So has the Act changed the bank's criteria at all? So I know that many recent media articles have been highlighting that this Act has changed your ability to borrow or to obtain a home loan. In fact, the Act does not impact on the bank's criteria or your ability to borrow. The bank's criteria and your ability to borrow it doesn't change regardless whether it was before the Act or after the Act. What the Act requires is the lender to evidence your borrower's ability to repay the debt. They also require the lender to be able to provide a clear evidence trail of your affordability. And here comes in regards to, and I guess the evidence, sorry, let's go back to that one. The evidence is pretty much going through your bank statements. They're looking at your income and your expenses. So these criteria there has not changed at all before the Act or even now. So how does the Act affect your application? So lenders now require a more detailed disclose in terms of expenses. However, the bank's lending criteria has been made the same, like I mentioned. So lender has the responsibility to do their due diligence when assessing an application. So they're actually looking at your spending habits as well as the standard expenses. So standard expenses are all necessities such as rates, water bills, power bills, and transportation costs. You will be required to evidence spending through your bank statements, credit card statements, which again, all of this criteria has not changed from the bank at all. We have always needing to provide all of those in details in the first place. So first of all, I guess when the bank is assessing anyone's loan application, they will look at the first of all is how they're looking at your income. So if you're a PAYE client, you earn a base salary or a fixed salary, they require to see your 3 months bank statements or 3 pay slips. So just to see the regular of income that's coming into your bank account. If you do earn bonus or commissions, they can actually average out over the last 2 years of income, and then this can be added on top of your base salary. That means that you will be in a better income positions where it will enable you to purchase a little bit more. Self-employed though is a little bit different because obviously your income is not stable every month or every week. It really depending on the income coming in that the business generating. So perhaps there's some months that will be doing a lot better than the other month. So given that the fluctuation of it, the bank requires to see at least 12 months of your financial statements. If you are starting up a new business though, however, there are lenders out there that are able to look at your financials, 6 months of financials, and then be able to use a 6 months forecast. So then that way they can kind of sort of see how you're tracking on. However, those are most of the time they are not main banks, so they're more like a near bank lenders. And the bank will also wanting to look at your IR3 tax summary, which showing your earnings, or IR4 business tax summary. So just to matching in regards to your last 2 years of earnings, together with your financial assessment, just so to make sure that they capture in the right correct income for your application. I guess the next one is the most important, where a lot of us are wondering, how is Cccfa making, impacting in regards to where people saying in regards to expenses. So each lender has a benchmark on standard expenses. So they would compare the benchmark with your actual expenses, and whichever one is higher for your application's assessment. So even, let's just say, if you have a very minimal expenses and it is a lot lower than the benchmark, the bank will still use the benchmark to assess your ability. So sometimes when you look at it, you may feel that the benchmark is a lot higher than your actual expenses, and you may not, in regards to, or like you're trying to cut down your expenses to be as minimal as you can. But I guess at the end of the day, the bank do have the benchmark. So as long as we don't go above that benchmark, you'll be, you'll sort of, you'll meet the criteria or in a safe position sort of thing. So standard expense includes food, groceries, utilities, motor insurance, transportation expenses. So if you were in a fitness, rego, car maintenance. So if you are thinking of like in regards to cutting down expenses, or are you thinking that my expenses were impacting your application, most likely they are talking about your non-standard expenses. So because for non-standard expenses, the bank calculate the actual figures and consider this in your application for assessment. So the higher this figure is, the lower your net income or your net monthly income is for your home loan affordability, and therefore it affects the amount or your borrowing amount. So non-standard expenses includes gym membership, Netflix, Spotify, Disney Plus subscriptions, childcare expenses, your personal risk insurance, basically your life, medical, and health insurance, donations, tithing, how often you dine out, how often that you're going to the cinema. Again, it comes down to your spending habit, how often you buying clothing, or how often that you going to the hairdressing. So it's part of your personal care. But the reason why is not a standard or classified as a non-standard expense is, I guess, is that in terms of not everyone spending the same amount, same level. It is not a necessity that basically, you cannot live without food and water, but you can live without, your Netflix, Spotify, with gym membership. So that's the way they see it. KiwiSaver contributions, of course, this is a really good savings, for your retirement schemes. Is being locked away, you won't be able to touch it. So in terms for you, it is building on for your assets. But for the bank, they actually consider this as an expense, because this is a compulsory savings, which reduces your monthly net income. So you'll have less income left per month to actually afford mortgage repayments. Some lenders also now include investment property expenses, such as the landlord insurance and the investment properties council rates. So again, of course, this additional expense that's being included there, of course, it will reduces your net monthly income, and therefore reduces the amount that you can borrow. So next one is they do look in regards to your liabilities or your line of credit. So common liabilities include home loans, personal loans, credit cards, store cards like Q Card, Gem Visa, American Express. So credit cards, lenders will always looking at your actual limit or your total limit of the card, not how much you're actually owing every month or your owing balance. So even if you're able to pay this off each month, the bank will still consider the full limit that you have got on the card. Now, throughout my years of working, I do have quite few clients that they do think the credit card is an asset, because what it is that they are able to use the funds at any time, any point. However, from the bank's perspective, it is a liability, because whatever that you use on the card, you are required to pay this back. And therefore, the bank or the lender has the responsibility to pretty much allow a portion of your income will be reserved as a repayment for these cards in case that you do use the full limit. So main bank credit cards, for example, like all of the major banks, so ASB, ANZ, BNZ, Westpac, Kiwi Bank, normally they reserve 3.8% of your limit per month. So when you're thinking, like, let's just put it, if you have a limit of 10,000, that is $380 per month that's being left aside to service that credit card, even though that you don't hardly use that limit at all. For store cards, perhaps like Gem Visa or Q card, they are reserving at 4.25%. So again, if you have a limit of 10,000, that's $425 that's being left set aside. That they are not going to account for your mortgage repayment, but to reserve to repay as a credit card repayment in case if you do use the full funds. Late buy after pay or buy now pay later schemes is very popular these days, and they are great. However, if you have an account open and if there's a limit that you have got on there, the bank reserve 8% of this limit per month for you. So again, this is a reduction in your income that impacting in regards to the borrowing amount or your ability for your loan amount. And lastly, obviously the Act requires the bank to always be responsible in lending. So they're also looking in regards to they also looking at in regards to having consideration of your retirements and liabilities. So any particular bank or any particular mortgage, they can provide you a maximum loan term of 30 years. Generally, the lenders will not support a 30 years loan term if you are over 70 years of age by the time the loan term ends. So when in regards to this, normally they would ask, or we would need to provide to them a clear exit strategy. So what it means is like, what is your exit strategy when in terms of, say, by the time that you reach retirement, how are you going to repay back the debt? So if you have an investment properties portfolio, then it's quite clear and not easy to the bankers that your exit strategy would be to sell down the assets or investment properties, and then you repay back your mortgage and you'll be mortgage free. Or if you have a really healthy superannuation balance, again, this could be used to pay off your mortgage at retirement and become mortgage free. The bank is not expecting you to work after you retire or work past the age of 70, trying to keep up in, with the mortgage repayments. Of course, that is that part where they need to be a responsible lender. They can't expect you to work for, I guess, the rest of your life. So in saying all that, I guess the most important thing is how to improve your application. I guess the best way to improve your application is knowing exactly what the bank's criteria is, what they are looking for, and how are you able to improve on your bank statements or your living style or your expenses. So limited spending on luxury goods. So I know that the bank, obviously, they were looking at your last 3 months bank statements. So if you spend quite a bit of money, just say if you buy branded products or branded things pretty much regularly, say once a month or like once a quarter or things like that, the bank will be able to pick this up, and then they will consider that as your spending habits and your expenses. So limiting spending on those luxury goods will help in regards with your bank statements, or keeping quite a clear standard expenditure for your application. Limit spending on regular small expenses. They all add up. So basically, like for example, that you're often going out for, say, you're often going out for dinner, or you eating out regularly, or in terms of, or let's just say if you're going to bar often, going to the movies every weekend, of course these are the expenses that is going to be on top of the normal standard benchmark expenses. Closure of unused credit cards, those credit cards that you're having a limit there, sitting there as a safety net for you. Of course it is, sometimes to provide that safety net, but when in terms to, like, if you're looking at applying for a home loan, perhaps getting rid of those credit cards, because of course that is going to impact on your home loan borrowing, regardless. So as long as the credit card is open, regardless that you've proven or like your history showing that you haven't actually used it for the past 6 months or the whole year, that you haven't been, like, you just don't use it at all because you don't need to. But as long as it's opened, the bank will still consider that as a liability, because you will have access to it, the very next day that you're taking a home loan out. So you're closing it off, meaning that it will increase your net monthly income in terms increasing your mortgage or your borrowing amount. Split lending into different banks. This one is, the reason for it is that, again, each different bank has different assessment rate, and therefore when you're splitting the lending among different banks, you and then that way you're able to maximize out your equity level. You're able to borrow money a little bit more, because one bank may be able to offer you a higher lending compared to other banks well. So always make a plan before you apply for the loan. So what the plan is, pretty much revisit in regards to your monthly expenses, revisit in terms of your bank statements, how is it looking over the last 3 months, if there any instance where I go into overdraft, having overdraft into your bank account also meaning it's not a great look, because it's showing that you are not managing your funds too well, whether if you have any regular sort of like a lot of expenses going, for example, like you've been going to the movies quite often, again, every week, or quite 2 or 3 times a week. Those are all the non-standard expenses that will add up on your application. And of course, choose an experienced mortgage broker. I mean, for example, us. So we do work with you, do a financial assessment for you, understand your financial positions. And then from there, if we identify anything that we think that the bank may be picking up on that will impact on your applications, we can give you a tailor-made solutions. Sometimes it may come down to in regards to improve your expenditure for the next 3 months, and then we will be able to approach the bank then. However, having us screening that beforehand or letting you know beforehand will help in regards to you having your be a lot prepared. So by the time it gets to the bank, it is very straightforward for the credit assessor to assess your application. Also very straightforward in terms of you don't have a lot of hiccups that you have to go through, or they don't have too many questions about your bank statements. And we've done that. And I guess, the next thing that we do have that's coming up is that if you're looking at buying your first home, we do have a first home buyer course. And then in the course, what you will learn is understanding the sales and purchase agreement, understanding the titles, limb report, different property types, how to look at in regards to the building inspections, what to do at open home inspections, and how to negotiate a deal with the agents, vendors, and solicitors, different sales types of method, picking the right property to buy, because so in obviously with Cccfa, the main focus on that act is talking about your income, expenses, and liabilities. That is to assess your affordability. But bank has three main criteria that you do need to achieve. First of all is that obviously you have got enough equity or sufficient deposit for the purchase. Second one is your serviceability, which we just talked about. And then finally, the third one would be the property that you are buying is acceptable by the bank. Again, there are many properties out there and the bank do not accept every single one of them. So it is always good to know the property that you're getting into, making sure that the bank would actually accept them before you actually commit into a contract of buying the property. Because worst case scenario is that if the bank doesn't accept the property, you will not be able to borrow the funds to actually settle on the house. It is, I think, at this stage, because given of our current COVID restrictions, I believe that our first home buyers course will be 2 days online. So 2 half days over the weekend, Saturday and Sunday. It is between 9 to 12 each day. So, and you also get a free copy of Lucia's book that she mentioned earlier, Financial Freedom, 5 years, or 5 Steps in 5 years. You also get a free ticket to our one-day workshop in regards how to buy or invest in Auckland. And then after the course, you also get consultation and tailor-made assessment with one of our mortgage advisors, including myself. And again, you have access to our first home buyers ambassador, which is my colleague Nguyen. So obviously, he has gone through his first home purchases and he has gone through everything in regards to identify the different title, identified the different clauses in your sales and purchase agreement, going through with the lenders, and as well as like how best to present your application to help you with the purchase as well.
Okay, I think we can just answer the questions. There are a number of questions, so you can click on the Q&A. And you can answer, from the bottom up. I think the first one is from Dev, was asking, does the Cccfa apply when investing into properties? Say like investment property, because I believe that it will be counted, as a business.
Yes. So then, it is counting as a business, but in regards to it is still relating to. Cccfa, sorry, it's still applied. It is still yes, it is a business investment property. But what the acts in talking about is in regards, the business activity is more like a trading sort of business. So investment or business at holding investment property is more like it's not classified as trading as such. Lucy, am I right? Like, yeah. So it's not like so much.
Unfortunately, I think because it's home loan you are applying, so the bank they will still check your expense. Yeah. However, if it's say like if you are buying a business and it's a business lending you apply, that will be different. Yeah. Or like commercial things. Yeah. So unfortunately, because it's home loan you are applying, and the bank at the moment, they are, still kind of looking at your expense, your personal expense, yeah, and also including all the other, like investment property that you have. They want to see all the council rates and, whatever, if it's, you had any body corporate, and also the house insurance. Before, that's not required. Basically, you don't need to provide those one because they already scaled in. I think you're probably aware of that. Some they actually scale the rental income at 75%, some was at 80%, yeah. So before they will kind of just take into account that, with your council rates and everything. Yeah. But we do found that, the different bank, they do treat it kind of slightly different. Some bank, they are really, really strict. Yeah. But some lenders, they are probably slightly more flexible. Yeah. So at the end of the day, we still have to look at what do you have? And then we can actually better to actually find a more suitable lender for you. Yeah. For your situation. Yeah. So I believe that I think you came to our workshop before, so I don't know which advisor actually kind of you've been dealing with. Yeah. Okay. Oh, cool. Yeah. Awesome. All right. So I hope that we answer your question here. Another question from James is asking that, what are the respective tax rate of ANZ, Resident, and Bluestone? I think James must be investor, yeah, so understand the tax rates, yeah.
Yeah, which is awesome. So at the moment, ANZ's tax rate is at 6.3%. Resume and Bluestone, which I'm guessing that you're meaning Select Home Loans. So their tax rate is at 5.75, or your current interest rate that you're paying plus 2.5%, whichever one is higher. So then they do stress test at that certain rate. So if you look at it as, let's just say that you can only say that your fixed rate home loan at the moment 3.5% fixed for 1 year, and then 2.5% on top. The test rate will be at 6% instead of the 5.75. So whichever one is higher on that one.
Yes, yeah. And sometimes don't get too hang on the tax rate and then just thinking like the highest tax rate, it's actually tougher to get lending, because there are also other consideration, like a banker, they have like a compulsory living expense, and different banker, they actually had a slightly, difference between them. So not necessarily the highest tax rate is the hardest to get funding. Sometimes it's not in that way, yeah. So again, because we got all the banks calculator, we got all the lenders calculator, and if it's you're particularly looking for getting more fundings, feel free to reach out to us, yeah. Okay, we got a question from Eva is asking like, what are your opinions on the interest rate movements in the near future? Should borrowers fix their interest rate for longer terms? It expecting the interest rate to rise. Thank you. Maybe I cover that, yeah. Because yes, I think interest rates have always been customers are always asking about the interest rate, yeah. And at the moment that I think you have to understand interest rate and also the official cash rate is a two different. It's two different. They have it's two different things, yeah. Because official cash rate will impact the bank of floating rate, but not necessarily on the fixed rate. Okay, so you will see it's a kind of a different that like when you talk about how long I'm going to fix it, we can see the official cash rate most likely it's going to go up to 1%. Because that's actually been related to the inflation, and I understand that last quarter's inflation it's quite high. Yeah, I think they're looking at 4.5% or 4.5%. Yeah. However, if you're asking, because obviously we kind of up there talking to the customer, we see what's going on. What we're seeing now is this quarter, I think the inflation might be not as high as the Christmas, because Christmas, everybody had to shop, like you had to buy stuff. Yeah. So I think especially that the business confidence level has dropped quite a bit. Yeah. Okay. So because that job that you will understand that, the Reserve Bank, as well as they want to manage the inflation, but they also want to manage the confidence and cash flow, because what I worry about is like if there's no confidence, on the market, people is not going to consume. So basically like if I don't have a confidence, obviously I'm not going to go out and spend, $5 buy a coffee. I probably will be, maybe I should save that money, right? So if I'm not spending money, that means the other people's income is going to be impacted as well. So I think what Reserve Bank, they have to be very, very careful, also looking at, what's coming up, rather than just looking at, oh my God, inflation is high, we have to increase the rate now. And I think there are talk about the bank, obviously the bank economists started talking about OCR, the official currency is going to be 3%. And usually the bank interest rate is going to add a margin, they are like 2%, yeah. So, but I think it's really unlikely. I think the issue with the economists is they like to predict, like a kind of like a long term, but the reality is like what I can see is usually just short term, every 3 months, like that's what I can see, because you don't know what Reserve Bank going to react. You don't know what other policies or like the government's going to introduce. I think we got this lovely Labour government, and constantly in the past a few years they have keep coming up with a bit of surprise for everybody. Bad, good or bad. Like But you have to understand that with all those new policy comes up, not necessarily they have impact straight away, but obviously they can either stimulate the market or they can cool the market. Yeah. So you can actually start seeing people start to react to it. Yeah. So my suggestion to you and to all the customers always being like, if you want to look for the fixed rate, look into the fixed rate. Always, I always just go for the but obviously you have to also fit into like your personal plan as well. Myself is always just going for the shorter term. Yeah. So that's what I'm doing, for myself. Yeah. Okay. But if you're not so sure, just reaching out to us. If you got something coming up for renew, just let us know. I probably should just put our contact detail here. Yeah. So in a minute. Okay, and then we got a same question. We got a question from Eva again. So, are the banks still accepting high LVR applicants, or are the banks requiring 20% minimum deposit for first-home buyer now? I think you can answer that, yeah, Lillian.
Yeah. So, at the moment, yes, some banks are still accepting high LVR applicants. So every bank now, what they're looking at is that with the LVR restrictions. So previously, every bank has its accessibility to a pool of fund. So previously, the Reserve Bank Nguyen said that 20% of that pool of funds that the bank is allowed to fund it out for our high LVR applicants, so then to help our first-home buyers with getting into the property sooner. With the new area restrictions, now the pool of fund has reduced down to 10%. So again, the bank has access to that pool of fund, but only now 10% of that portion is being able to, or allowed to actually lend to our high LVR or first-home buyers that are having less than 20% deposit. So the bank has changed it as like mainly most of the banks, they only focus on their existing bank client. So main bank client. So main bank to the bank, meaning that your wages and salary go into their bank. So then they are prioritized your application over any new to bank customer to ensure that they are looking after their customers. So the bank, again, for us is that we do get an update from the bank. Obviously, the pool of funds will be exhausted out, and then it'll be available again, when people are starting to pay back money into that pool. So we get we get updates regularly from the bank in terms of whether if they have an opening for applications of high LVR or not. So then pretty much if you have less than 20% deposit, feel free to come in and talk to us. We will identify which bank that you're with, so then that way we can actually follow up with the bank. As long as that pool of funding is available, we submit the application off and then for them to assess on that.
Okay, yeah, all right. So another question from Karina is regarding the liability. Would it be fine if I cut it 3 months prior to the potential lending time, e.g. if I'm planning to hunt in August, that would it be okay if I cut in May or earlier?
On the note, yes, but also sometimes you actually don't need to cut it off before you approach the bank. Because the thing is, the bank would know in regards, they do look at in regards to your proposal to them. So say that you're obviously, once you get a home loan, your financial positions will change. So what we can propose to the bank is that you are now wanting to apply for your home loan, you're wanting to focus on in regards to buying your home and be a homeowner, also wanting to focus on repaying down the debt as fast as you can. Therefore, once you get the home loan or once you settle on, you will close off all of your cards and liabilities, which means that it can be a condition to your loan. So you actually don't need to cut it off before you approach the bank. You can actually still have them while you approach the bank. But what it is that by the time that you get your final approval, that is when you'll need to sort of cut off or close off all your credit cards. So it's kind of like you're telling the bank that you will get it done. And then for them to give you an approval first, and then that will be as the conditions of your loan. So you can take your time and paying them off too if that is something that you are planning to do. Because of course, once you, out there looking for your property, there's time to you finding it and also time to actually settling on the house. So there's plenty of time for you to get that done.
I kind of like did a calculation on the say like a $5 coffee a day. So a week it will be like it will costing you $35, right? And then on the monthly basis, you kind of looking at like a how much you're looking at, like 35 times 52 times per month, you're looking like $151. So $151, it does actually impacting your $25,000 borrowing, $25,000 borrowing, yeah. So I guess like if you can looking at to cut down the expense, that's great. Just make our life much easier. Yeah. Okay. Absolutely, and also make your life much easier. Yeah. But sometimes we do have a lender come back and asking for 6 months. Like we do have a lender come back and asking for 6 months bank statement instead. Yeah. But I mean, if it's you can really actually kind of like live on a very frugal life, that's brilliant, because obviously that just prove that to the bank that you are a great saver. Like, and it's certainly adding some bonus to your application. Yeah. Okay. But I think what Lillian is talking about is also like on your credit card, it can actually subject to the, we can actually put a condition there, like, and you can actually just cancel the credit card before the settlement. Yeah. Okay. Another from Christina. Yeah. So I'm going for pre-approval in mid-February, and they only gives us 60 days pre-approval, and the settlement of the next bill turnkey is mid-April. Feeling so scared if it gets declined, as we already pay 5% to developers.
I think they actually have. So when it comes to a turnkey application, the bank has a different slight policies around that, because obviously when turnkey it could be a whole 12 months away. So with the approvals, so when you pre-approval is different. Pre-approvals meaning that you haven't actually found a property, or you haven't have any property, or the bank hasn't actually assessed it yet. So then they don't know what type of property that you're wanting to buy. But if you already found a property to buy, the bank will give you as a conditional approval. That one normally valid for 90 days. So on a conditional approval valid for 90 days. So what it means is that the bank has already know that this is the property that you are buying. They have already assessed or screened the property, and they accepted that as security. The condition is basically whatever that you're needing to provide in case that I guess most important of the turnkey will be registered valuation, triple code of compliance certificate, or certificate of title. Pretty much that was the thing that you're waiting for to get it like a final approval for that. So I believe that you should get a longer approval date than the 60 days that's mentioned on there.
Okay, and so question from Christina. So do you think with a 50% deposit for a property of 450 on a combined income of 120, we will still get approved? I'm pretty sure. Yeah, I think that would be an easy case. Yeah. Yeah.
That would be really easy.
It's easy peasy. Yeah. Absolutely.
No problem at all.
I think you can borrow more. Buying something better. Better quality property. Yeah, if you want to. A question from Claire. So regarding the 3 months bank statement, if we are applying for the loan in February, but the settlement is in April, will the bank relook at our 3 months statement closer? No, they don't. So January. So basically, you only apply you only supply the bank statement, at the time when you are applying the application. I never seen bank come back before the settlement and asking for like updated bank statement. Yeah, not really. What if we get a pay rise after our pre-approval? I mean, a pay rise is always good. Yeah, would it be after we affect our loan amounts? Because I think they do have changes, like in their policy there. So if it's you are not looking for like an increasing amount, I would think just keep it as it is. Yeah. But just I think Lillian already explained pre-approval is it's not an approval. So if it's you got a pre-approval, you actually pre-approval only just telling you how much you can borrow. It's not saying like you can buy that particular house. Yeah. Okay. So I think you do need to actually kind of get in contact and get the condition approval. That's actually the one that you have to start working on. If it's a settlement, it's actually in April. Yeah. Okay, I kind of like jump into the answer question. All right, Christina, if we go for pre-approval in mid-February, they are gonna look from mid-November, but I had shocking spendings over Christmas, settlements in mid-April. So should I leave my pre-approval meeting to last minute? I leave this one to you, Lillian.
When it comes to lending, never leave anything till last minute because you don't know what the bank is going to ask the questions. However, you don't need to be well in advance either. So if you are looking at, if your settlement is looking at around in mid-April, you probably can start looking at applying, I would say, end of February, beginning of March. So you're giving yourself at least about a month or a bit to actually, again, when you're working with a mortgage advisor, giving them a bit of time to prepare your applications, to, I guess, in a way to perfect the application, and also giving the credit assessor some time to assess it as well. Now, when you're talking about your expenses during Christmas and things like that, obviously it is a festive season. So many of us do have a higher spending over Christmas in regards to giftings and things like that. And then I guess one way that we have been able to, I guess, mitigate around that with the bank is, of course, those are one-off expenses. So it's not likely that it will be, this is the continuous spending habit that you're having. So sometimes it will help in regards to mitigate around your spending habit when it is in regards to like occasion or during the festive season. But yeah, so if your settlement is in April, I would say approach a mortgage advisor now, just get the ball rolling, and perhaps we will have the application ready and go to the bank at least at the beginning of March to get everything prepared. Because remember, once the bank approve it, they also need to prepare for your loan documents. You will then need to go to your solicitor to sign the loan document. Solicitor will then need to send that documents back to the bank and then prepare for the paperwork on settlement date. So there's a little bit process around that then rather than just, closer to your settlement date.
We kind of usually kind of leave like at least like maybe 3 weeks or something. It's just like allow time to actually do the process. Because obviously it's a bit of process to submit the application. The bank need to approve it, and then also have to come back to you to confirm the structures and the pricings and everything, and also long documentation to go to your solicitor. So ideally it's like that, but obviously we have done cases that you can turn it out in 1 week, it's also achievable as well. But I mean, if you want to get in contact with us, I did leave our contact details here. You can actually just send it in and I can get Lillian to actually work on that for you. Also, we had another question here from Tomoy. Yeah, so does split banking or using second-tier lenders help now overcoming strict restrictions on banks' DTI rule? Even if I use split banking, second-tier lender, both the lenders are going to count all the debts for both lenders. Am I correct?
Yes, you are. So when it comes to DTI, which is debt to income ratio, the rules is that your debt cannot be, say at the moment, is 6 times above your income. So it is your total debt portfolio, not just from one particular bank. So when you split your lending for the DTI, it doesn't really improve it because your total of debts is still there, even if you're using a second tier. However, I know that there are banks that sort of have a different, sort of a little bit more lenient in terms of DTI, so then they're able to look in regards to a little bit higher than 6 times. Sometimes it can go up to 8 or 9, or one of my clients been able to get around the 8.5, 9 times DTI. So it really depending, I guess, how strong the application is or how strong your mortgage advisor present your application or how well it's being put together in terms of mitigation around the DTI rule. So the splitting of the banking, what really it helps is in terms of your borrowing amount. Of course, like we mentioned earlier, different banks have different test rate as one, and also different bank have different benchmark on your expenses. So again, one bank may have a lower test rate and also a lower benchmark on expense, and therefore they're able to let you borrow a bit more. And that's why splitting up with the banks is will be more, I guess in a way it's more efficient or beneficial if you're looking at for the maximum lending amount that you can get to for your next purchase.
Okay, so we got another question from Amber. It's asking, is there a better time during the year to apply if you actually have a less than 20% deposit? Yeah.
To be honest, no. There's no better time. It's really depending on when when the funding from the pool is available and when it's open, and we just pretty much jump in as fast as we can. So it is always good that you are always prepared to get your application over to the bank as soon as it is there. And I guess at the end of the day, it is always, the same questions as a lot of people has been asking us is like, when is the best time to buy? And of course, the best time to buy is now, because then, the longer you wait for it, the value of the houses will continue to increase. So the earlier you get into the market, the sooner that you will be able to benefit from the gain. That.
Yeah. Okay. All right. We've got another question here. Is Karina is asking that, may I know how the banks generally calculate? Oh, maybe just Amber, just get in contact with us, because obviously we get all the updates straight away from the bank. So when they do have a funding, that we will know straight away. Yeah, we can let you know. So may I know the banks generally calculate the rental income? So
Yeah, so your rental income, they were always looking at in regards to your gross rental income, that is any before taxes as well as before any property management fee and any other kind of fee that you're paying for, because what it is, the bank actually scale down your rental income. So nowadays, because obviously of that interest tax deductibility rules that the government issued out last year, you no longer. So for the new build, the one that's classified under exempt for the tax deductibility, you were looking at scaling of 75% of the gross income. Whereas if it's under properties that existing house that you're buying, rental income is being scaled down at about 65%. Obviously, it is to allow for that tax payment that you get.
Okay. Question from Katrina is asking how to sign up to the course. So you can click there's an offer layer, so you can click on the link layer. I think we can do a special, just for you and your partner, it's $297. $297. I think this is live in our office, right?
No, we are doing online.
Oh, we're doing online this time. Okay. Yeah. So all you need to do was click. I think there's an option there like enrollment, and you just click on the just one ticket. $297. So if we are running online one, will be actually like 2 half days. Yeah. So so it's actually Saturday and Sunday, 9 a.m. to 12 p.m. So it's really, really in depth that we actually taking you through, because we understand that how expensive for you to get your solicitor to check your sale and purchase agreement, to check the title, to check the lien. But we actually literally teaching you. Okay. So if it's you do actually come and using our mortgage services, we offer this for free. We will check your sale and purchase agreement. We will tell you that whether it's a clean one or there's something that you do need to worry about. We will tell you. Yeah. The title, we will check the title for you. And also we will actually check the lien report for you, because we know that, very often that, the customer, they were wasting their money doing the check. Yeah. And then they realize that ultimately it's probably not the property they're going ahead with. Yeah. So I think I feel quite, the first home buyers usually feel quite frustrated. They already had a very, very limited deposit, and then they ended up because the lack of the knowledge, they ended up having to spend more money than investor like myself, because usually obviously I know how to do those ones, so I don't need to ask my solicitor, I don't need to ask the builder to actually come and look at the house. Yeah, because generally speaking, we were actually teaching you like what you are looking at. Like when you actually go and kind of like go to the open home, what are you looking for, and also how to talk to the agent. Yeah, so that's all the the tips that we will share with you. Basically taking you through the whole process. So we know that very often the first home buyers spend the money, get the solicitor to check, and each time they're charging you a few $100. Yeah, okay, each time that for each property, and I don't believe that you actually have that money for it. Yeah, so so that's important. And also the building inspection. We're teaching you how can you actually quickly check the building inspection as well. Instead, you have to pay someone to do it. And also we will tell you that you don't need to do valuation, because very often we saw people missing out in the auction rooms because they've done the valuation. We tell you why you shouldn't do the valuation. Yeah, you do that after. Yeah, okay. So that's actually all in the in a class. Basically we will kind of handhold, just teaching you, everything, as a first-time buyer, and what you should really actually kind of looking for. And absolutely, we had so many clients that really enjoy the courses, and just give them the confidence of being able to knowing what they are looking for. Yeah, okay. So all you need to do was actually just sign up. I think this one was just the one, the one ticket one, $297. It's online, so yeah, your partner can be there as well. Yeah, okay.
So to add on that one too, is that obviously we another thing to that is that when you, let's just say if you go through a list of properties that you're wanting to look at, the solicitor will actually take time to actually go through that list. So as you can see with the market, before Christmas and things like that, when the market when a property going to auction and things like that, but auctions are continuous being brought forward. And if you're waiting for a builder to come out to do inspections, by the time that the builder has a slot available for you, you probably will already miss out on the property. And so by the time that the solicitor can get to the property that you want, it may be a perfect property, but because you were waiting for them, you may have missed out on the purchasing of that already, because obviously the auction has already been and gone. So again, the course will help you in regards to identify all of those knowledge and all of those skills, where you're able to have a review of that yourself, so you're not relying on other people's time schedules, and so you can act pretty quickly, responsibly in regards to with the property purchase.
Okay, Karina is asking, so how do banks view borrowers who want to purchase two property within 12 months period? The bank don't have problem for it. Yeah. Myself, I think sometimes I had in 1 month I was purchasing 4 property. Yeah, and that was when I first started out. Started investing, and even last year, I think I bought a number of property as well. Yeah, so it's okay as long as your servicing is fine. You got enough equity there. That's all good. Another question is how should I evaluate prior to making an appointment with your guys? Yeah. I don't think you need just reaching out, yeah. And I think Lillian will help you to actually kind of look at your positions and see what we can do for you, Karina. Yeah.
So yeah, just reaching out to us, give us a call, and then we can go over that. We will always start in regards to a bit of a brief overview of your current positions, I guess, your goals, what you're wanting to do, and then we can go in more in-depth detail in regards to a financial assessment. So nothing you have to prepare before talking to us, or perhaps, once you talk to us, that I guess we'll give you some ideas in regards to what you need to prepare for it.
Okay. And Zha is asking on my wife and I earn close to 130,000 per annum. So that's really standard one, for a couple. Yeah, we have about 10% deposit to a $750,000 house in Auckland. Still, we haven't contacted any mortgage brokers or banks. Yeah, what would be the ideal things to do first as a first-home buyer? Probably just reaching out to us, I would think. Yeah, yeah. Just if you and then there's a contact detail there, so all you need to do is just fill out online form, and then either Lillian or our advisor, they can get hold of you. Yeah, and then we will actually come out with a plan for you. Okay, wonderful. Duff is asking, how much reductions is there in borrowing for every dependent child or elderly and every vehicle owned?
So for every dependent, you're looking at a deduction of about 80K to 100K in lending. So, and at the same as the elderly, it's something depending on you as well. Every vehicles, I guess, is in terms that, yes, if you have more than the one vehicle, then the bank will look in regards to adding that extra vehicle expenses on, onto your application. So again, I guess Wolf Free Joe, car maintenance, petrol, vehicle expense of insurance, that's going to add on that for you. So
So it depends on how much you spend on the additional vehicle there, like, because say like you might pay $1,000 in insurance plus your petrols, and the petrol might be, I don't know, $100, maybe. I mean, now it's probably a bit less, yeah. So it might be $100 a month. So you're probably kind of looking at $200 a month, yeah. So that's roughly probably taking away like, $30,000 borrowing power. I think with the dependent trial, how much the bank are using the number? Just 300 and something, is it?
380.
380, is it? Yeah. So I can give you a quick calculation. 380 divide 3. Yeah, it's probably 60 grand, 61 grand, like if it's using the tax rate of the 6.3%, yeah. So it does reduce quite a bit of borrowing power but obviously, if you've got kids, if you've got dependent kids, they are under 18, you do have to disclose, yeah. Okay, and unless they are not living with you, yeah, okay. And that's probably different. Okay, cool. Right, and then question from Michael: what are the risks to re-enter the property later if we sell off our only home now? My answer is don't sell. Don't sell. I have seen so many people that sell because they are unoccupied home, and then they sold it. They thought, and then they absolutely regret about it. So if you only have one house, never ever sell it. Yeah, you should always buy before you sell. And also at the moment, it's actually buyer's market, not seller's market. So I don't know what's the reason that you are thinking about selling it. But if you are looking at like either upgrade or downgrade, always buy first before you sell. So when you buy first, you can always have a 3 months settlement. So that will allow you to actually have the time to actually sell it. And also if it's the settlement day is different, if it's the bank, they do offer like a closed bridge. So closed bridge is like, the both settlement day, and then they can actually offer like a bridging loan for you, because you might actually have a date that you sold a house and say like a settlement date on the 1st of May, but you actually bought a new property, and then the vendor might insisting, no, you need to settle on the 15th of April. So they are like 2 weeks there, okay? So in that case, that if it's, you do have a both settlement date, you can actually have this bridging loan from the main bank. If it's you don't have a confirmed settlement date, you might end up have to go to the non-bank because it's open bridge, yeah, because there's no confirmed date, yeah, and it can be a bit more expensive, yeah. But again, never ever sell your own home if you only have one there. Okay, never ever, yeah. And feel free to reaching out to us again. All right, a good question from Rima. So will previous homeowners be categorized as a first-home buyer and able to use Kiwis? Oh yeah, so this is called second chance first-home buyer. And if it's you never using Kiwis before, yes, you are qualified. But to withdraw your Kiwis, your assets shouldn't be more than 20% of the cap. Like say like in Auckland, I mean the price cap is actually 625,000. So 20% of that is how much? 130. Is it 130,000? Is it? Yeah. So you have to be very careful, like when you are applying. When you are applying the Kiwis withdrawal or 125,000, so remember that your total assets, because they do asking you to fill out a form, and then they want you to know, hey, what's your assets? Yeah, so your assets is actually including, obviously your cash savings and and also including like your contents, your vehicles. So I mean, like, so obviously you don't want to put a vehicle like it's like, I don't know, like 50 grand or something. Maybe you want to reduce that and making sure that your total assets is only maximum, you know, like it had to be less than 125,000 because there's a threshold they're using. Yeah. So one criteria is you never using Cccfa before. The second criteria is your assets is less than 20% of the price cap. Yeah. Okay. If you're not so sure, again, reaching out to us, we will explain to you. Yeah. Okay. All right. I hope really answer that. Okay. Another question from Div is how much reductions in borrow? I think we answered this one before, isn't it? Okay. Cool. Yeah. All right. Just have a look on the see have we got any more questions? Oh yeah, everybody said thank you. Oh, that's good. Yeah, yeah. I think that's why we are here for. Yeah. The upload video
has a question. Yep, this video will be uploaded later. You will get a replay link from us via email, so you will be able to rewatch this.
Yeah, so there will be a replay link to actually send to you. Yeah. Okay. Awesome. I think pretty much we cover everything. Yeah. I mean, just for some of you, you are wondering how we actually do a calculation of that, how that $5, coffee is impacting you. That's how I did it. Is like you can actually using the mortgage calculator, and you can actually using like a tax rate, say like a 6.3%, and you will figure out like for borrowing every $100,000, you do need to have a monthly net income of $619. So, and then just, working back, like if it's your coffee is costing $150 divided by that 619, you will figure out that it's roughly $25,000 impacting on your borrowing power. So that's actually how we actually do the calculation. Yeah. Okay. I guess we probably pretty much cover everything. So we would love to see you on our On My Home. If you are the first home buyers, like obviously that this On My Home courses, it's brilliant for you, saving you thousands of dollars. Because every time when we come across the first home buyers came to us and then they spend $2 or $3 grand to do a due diligence on one house, and you're wondering like, oh my God, yeah. And not necessarily they were actually being able to successfully secure that. So our job is actually helping you to understand like, all those, to us it's quite a basic one, but obviously like for some of you that you haven't really go through a process, to you can be quite daunting, like, oh, what I'm reading on this is sale and purchase agreement. How about this title? What's it mean? Like the limb report, what I'm looking for. How about the inspections? And also like how to talk to the agents. They can be very intimidating. Yeah. In my book, I shared a story like many years ago that when we actually buying our first home, I think obviously you got this very nasty agents, kind of interrogating my husband and say, well, can you afford it? Yeah, okay. But how are you dealing with that? Yeah, okay. Because you need that confidence of being able to successfully secure the property. So these courses absolutely were helping you to do that. Yeah, okay. It's 2 days. It's a Saturday and Sunday, 9 a.m. to 12 p.m. And Lillian and Nguyen, they will be facilitated, right? Okay. And also, you got a free like consultation and everything. And also, you also get a free ticket to come to the one-day workshop. So our one-day workshop, how to buy or investing in Auckland. This is it's more on the investment level. Okay. So if you are interested in how to actually using your first homes to actually tap into your property journey, and absolutely that's something for you. Brilliant. Yeah. Okay. Thank you so much, and have a good night. Yeah. Okay. We should see you like next time. Yeah. See ya. Bye.
Thank you so much. Take care. Bye.
Bye.